Warren Buffett is widely regarded as one of the greatest, most successful investors of all time. While the 90-year-old certainly has more experience than most, some claim that Buffett's performance, particularly since 2009, is more myth than reality. The chairman and CEO of Berkshire Hathaway may still be one of the richest people in the world, but here are 10 investors who have actually had higher returns than Warren Buffett. Joel Greenblatt is a hedge fund manager, investor, writer, and adjunct professor at the Columbia University Graduate School of Business. Together with his partner, Robert Goldstein, he runs Gotham Asset Management, which Greenblatt started as the hedge fund Gotham Capital with $7 million in 1985. While Goldstein joined the fund in 1989. Through Gotham Capital, Greenblatt presided over an annualized return of 50% after all expenses but before general partners' incentive allocation fees, or 30% of net fees from 1985 to 1994 by investing in special situations like spin-offs and other corporate restructurings. In 2006, Greenblatt published the widely read book, The Little Book That Beats the Market, in which he makes the case for a formula that investors can use to be successful over the long run. Essentially, Greenblatt's formula looks for businesses with a large earnings yield and a high return on capital, with the premise being that in the long run, stocks of companies that are both cheap and good in quality would greatly outperform the stocks of companies that are just cheap. His formula evidently worked for Greenblatt, who says that from 1988 to 2009, his magic formula produced a compound annual growth rate of 23.8% versus a 9.6% rate for the S&P 500. Until his death in June 2019, American investor and mutual fund manager John Neff was notable for his contrarian and value investing style as well as for heading Vanguard's Windsor Fund. Neff joined Wellington Management Co., a sub-advisor to the Vanguard Group of Funds, in 1964 and stayed with the company for more than 3 decades. In 1967, he was appointed portfolio manager of the Windsor, Gemini, and Qualified Dividend Funds, which he managed until his retirement in 1995. During Neff's 31-year-long tenure, Windsor Fund became the highest returning fund, returning 13.7% annually versus 10.6% for the S&P 500. This amounts to a gain of more than 53 times an initial investment made in 1964. Neff's preferred investment tactic involved investing in popular industries through indirect paths. And since he liked to focus on companies with low PE ratios and strong dividend yields, many considered him a value investor. However, others considered him a tactical, contrarian investor who placed emphasis on low-tech security analysis, that is, digging into a company and its management and analyzing the books. Either way, Neff's strategies generated relatively high turnover with an average holding period of 3 years. One area in which Neff was similar to value investors such as Warren Buffett was in his emphasis on return on equity, or ROE, stating that it was the single best measure of management effectiveness. But unlike many value investors, he also focused on predicting the economy and projecting a company's future earnings. Paul Tudor Jones II is one of the most successful hedge fund managers. He's known for his macro trades, particularly his bets on interest rates and currencies. In 1980, he founded the Tudor Investment Corporation, an asset management firm based in Greenwich, Connecticut, that focused on assets in fixed income, currencies, equities, and commodity asset classes. According to Jones himself, he is the most conservative investor in the world for one simple reason: he hates losing money. So when investing, Jones tries to avoid taking any risk and says he doesn't like the idea of having much of his money tied up in stocks. His success has made him a multi-billionaire, and since opening his flagship Tudor BVI fund in 1986, the Memphis, Tennessee-born trader has posted an annualized return of about 26%. Investors say a strong and steady performance like very few managers of the hedge funds can boast. American investor and mutual fund manager Peter Lynch is one of the most successful investors in history. As a proponent of value investing, Lynch wrote and co-authored a number of books and papers on investing strategies, including One Up on Wall Street and Beating the Street, which have sold millions of copies and are considered mandatory reading for any investor. While you might not recognize his name right away, you may be familiar with some of the mantras of modern individual investing that Lynch coined, such as know what you own and know why you own it, and never invest in any funny idea you can't illustrate with a crayon. Lynch has been described as a legend by the financial media for his impressive performance record. If you had invested $1,000 in Fidelity's Magellan Fund during Lynch's tenure, you would have earned $28,000. Lynch reportedly beat the S&P 500 index in 11 of the 13 years he managed the fund, transforming $18 million in assets into more than $14 billion. This translates to an annualized return of 29.2% during his time running the fund, more than twice what the S&P 500 earned during that time. Carl Icahn, founder of Icahn Enterprises, is a highly successful activist investor. As such, he likes to buy extremely cheap businesses that the market hasn't shown much love to, and then build large stakes within those companies to be able to influence the board of directors and provide guidance on the strategic operations of the companies. Icahn has at times been so active that there is something known as the Icahn lift in the world of investments. This phenomenon describes the surge in stock price when Carl Icahn starts acquiring shares in a company. Some consider Icahn a more successful investor than business tycoon Warren Buffett, and in some ways, he has an arguably better record. From 1986 through 2011, Icahn grew his original $100,000 investment in his firm at a 31% annual rate, while Buffett's Berkshire Hathaway had only a 20% annual growth rate. While this statistic doesn't offer a full picture of each investor's stock picks, it is still an important point of comparison. Icahn's return rate means that every $1,000 invested with Icahn Enterprises back in the late 60s would have turned into $325 million today, which is not only an incredible number, but also means that Carl Icahn has outperformed Buffett over the past few decades. Born in Hungary in 1930, George Soros is a renowned hedge fund manager and one of the world's greatest investors. As opposed to Warren Buffett's slow and steady approach, Soros likes to make bold yet very profitable bets. The billionaire investor became known as the man who broke the Bank of England because of a transaction he made on September 16, 1992, the Black Wednesday UK currency crisis. On this day, Soros made a single-day gain of an unbelievable $1 billion by short-selling $10 billion worth of pound sterling. This successful bet also cemented his reputation as one of the premier currency speculators in the world, and today, Soros is known for the unmatched success of his Quantum Fund, an investment of just $1,000 back in 1969 when Soros established the Quantum Fund would have been worth $4 million by the year 2000, as it's achieved a cumulative 32% annual return during that time period. Founder and former chief executive of the Vanguard Group, the late John Jack Bogle was credited with creating the first index fund. Until his retirement in 2016, he was an avid investor and money manager himself, preaching investments over speculation, long-term patience over short-term action, and reducing broker fees as much as possible. In 1999, Bogle published a book entitled Common Sense on Mutual Funds: New Imperatives for the Intelligent Investor, which became a bestseller and is considered a classic within investment communities. The same year, Bogle retired from Vanguard after the company had become the second largest fund company under his leadership, commanding $428.4 billion, or 8.83% of all mutual fund assets by 1999. The number one spot that year went to Peter Lynch's Fidelity. The ideal investment vehicle for Bogle was a low-cost index fund held over a period of a lifetime, with dividends reinvested and purchased with dollar-cost averaging. This is pretty much the opposite of Warren Buffett's investment strategy, but considering Buffett decided to leave 90% of his will in a Vanguard index fund, it looks like Bogle's strategy wins this round. Before he retired a couple of years ago, Bill Gross was the world's leading bond fund manager and was considered the king of bonds by many. He is the co-founder and former managing director of the PIMCO, Pacific Investment Management Company, family of bond funds, the largest global fixed income investment company. Until he left to join Janus Capital Group, now Janus Henderson, in September 2014, Gross and his team had more than $1.92 trillion in fixed income assets under management. In 1996, Gross was the first portfolio manager inducted into the Fixed Income Analyst Society Incorporated Hall of Fame for his contributions to the advancement of bond and portfolio analysis. During his career, Gross mainly focused on buying individual bonds, and his investment style always focused on the total portfolio. According to Gross, investors should always have a long-term outlook for their portfolio and structure it accordingly to take advantage of this outlook and to avoid getting emotional whiplash of the day-to-day markets. It certainly appears to have worked out for Gross, who managed a total return for his fund investors of around 50% over the decade leading up to his retirement in early 2019. American investor and hedge fund manager Bill Ackman is the founder and CEO of Pershing Square Capital Management, a New York-based hedge fund management company that he founded in 2004, with $54 million from his personal funds and from his former business partner, Leucadia National. Ackman is considered by some to be a contrarian investor, but considers himself an activist investor, and his company has launched activist campaigns against McDonald's, Wendy's, and Herbalife. But regardless of the kind of label Ackman bears as an investor, the 54-year-old is currently one of the most successful financiers and is estimated to be worth around $2 billion. In 2020, his company delivered a 70% return on its investments, easily passing the benchmark S&P 500's 16% gain for the year. Ackman said Pershing Square had a net return of 4.6% in December 2020 alone, and the company also greatly surpassed its previous record of 58% in 2019. Michael Steinhardt is the founder of hedge fund Steinhardt Partners and a Wall Street legend. Over the nearly 30 years between 1967 and 1995, his hedge fund returned an average of a very impressive 24.5% annually, even after Steinhardt's 20% cut of the profits. This means if you had invested $10,000 into Steinhardt's hedge fund back in 1967, you would have ended up with $4.8 million by 1995, when the hedge fund closed. To put this into perspective, the same $10,000 in the S&P 500 would have only been worth $190,000. Steinhardt's success was possible due to a wide variety of financial instruments, ranging from stocks to bonds to options. Unlike many other investors, he is not focused on just one investment strategy, but is equally proficient in short and long-term horizons. This has made him one of Wall Street's greatest traders, who evidently isn't afraid of voicing an unpopular opinion about Warren Buffett. Back in 2011, Steinhardt said about Buffett, "He is the greatest PR person of recent times, and he has managed to achieve a snow job that conned virtually everyone in the press to my knowledge."